Hello, class. Okay, I'm going to apologize about any background noise. I'm actually at the airport. I know that's a little unusual to record a video at the airport, but here I am anyway. So I wanted to go over just briefly how to prepare a bank reconciliation. So everything about a bank reconciliation has to do with timing differences because obviously cash is cash, right? So every single thing we do has to do with timing differences. And when we do a reconciliation, what we're doing is we are taking the balance that the bank has and taking the balance that's on our general ledger that's actually in our bank account, and we're reconciling the two so that they're the same. And that's a control procedure to make sure that we have correctly recorded the deposits and the checks that we've written and anything that the bank, like interest or notes that they've collected for us. So this is a good summary of like we're adding or deducting timing differences or errors, but we're going to look at specifics. So let's look at the left-hand side. We have the cash balance per the bank. The first thing that we have to reconcile for is deposits in transit. Okay, so what that is let's say that it's the last day of the month and you receive a $2,000 check from a customer. And you're obviously going to put it in the bank on your way home from work. Then there's the cutoff. Is that deposit going to be reflected on the bank statement? No, it's not. It's not going to be reflected on the bank statement because the bank doesn't know about it yet. But is it going to be reflected on your books? Yeah, it's going to be reflected on your books because you're going to record the deposit when you receive the money and you make up the deposit slip. So we have to take that amount and we have to add it to our bank balance because the bank doesn't have it, our books do. We have to add it to the bank balance. The next item is outstanding checks. So let's say that you do payroll at the last day of the month and you give all of your employees their checks. Are all of those checks going to be subtracted from the bank balance? No, not on that day, not at the closing of the month. What about your books? Are all of those checks going to be subtracted on your books? Yeah, you subtracted them when you wrote the checks. So it's on our books already, but the bank hasn't accepted it. So we have to subtract our outstanding checks from the bank balance. Now the last item here are errors, and they can go one way or the other. They're less common, but they're more complicated. All right, now let's look at our books. So our balance on the books is a lot simpler to reconcile. The types of items we'll typically see is like, let's say the bank collected a note for us. In reality, they'd send you a note in the middle of the month as soon as they do it, and you'd probably record it. But we're going to pretend like we don't know about it until we open the bank statement. So if the bank collects a note for us, we're going to add that to our book balance. Because when they collect the note for us, the bank already has it on their books. We don't. So we're going to add it to the book balance. The same goes for interest. I know a lot of us don't have interest on our personal accounts anymore. Maybe some of you are old enough to remember when everybody did, but probably most of you are not old enough. A lot of commercial bank accounts still have interest on them, albeit small. So when you get the bank statement, you see how much interest you've earned, and you need to add that to the book balance. The other thing that can happen is we can have a customer that wrote us a check, we deposit it in the bank, and when it got to the bank's like, no, they don't have the money for this check. So they return it to us with insufficient funds. So we have already recorded the receipt of that money. So it's already on our books, but the bank did not add it to our bank balance because there weren't sufficient funds. So we have to subtract that from our book balance. And then the last thing that we have to deal with are errors, which can go either direction. When you're all done, our cash balance per the bank should be the same as our cash balance per the books. The cash balance per the bank should be the same as our cash balance per the books. All right, so the next video, I'm just going to work through an example of a bank reconciliation so that you can kind of see how it works.